again, and thank you for joining us. Today is Tuesday, the 23rd of August in 2022, and this is our market insights and observations. So let's get right to the news of the day. Right now, out of the gate, we had housing data and housing update, and a lot of market prognosticators, even analysts are calling for a housing recession. Are we in one? Are we not? Even on the U.S. economy, are we in a recession? Are we not? The answer is yes. There's a technical recession by way of two negative quarters back to back of a GDP print, and we just received that earlier this year, the first quarter, followed by the second quarter on the U.S. GDP. So yes, the U.S. economy is in a recession. It's strange because jobs are not impacted just yet, but wait, don't hold your breath, and here's why. If you followed along on my videos, my updates, insights, and observations, I pointed to earlier what the Federal Reserve is doing. They're slowing down the economy by pumping the brakes, by raising interest rates. And that ultimately, over 8 months ago, we saw it hit the equity market, which is the stock market, and the bond market. And obviously, we've seen what the market impact has been as a result of what the raising and the tightening, raising of interest rates and the tightening of Fed policy, meaning not being so accommodative, not having money just slushed around like they did the last previous years. That's slowing down. It's taking liquidity out of the system. So it hit the stock and the bond market about 8 months ago, followed by the cryptocurrency. Again, we're not recommending it. We're not investing in it. But it's important to note that the cryptocurrency market was impacted as well. That's a wealth effect negatively to the U.S. economy. It started out in the middle of the year. If you think about it, just by the Super Bowl. The Super Bowl commercials, every Super Bowl commercial was crypto, right? Well, at that time, the crypto market was valued about $3 trillion. Today, it's less than $1 trillion. So that's well over $2 trillion out of the market, right? That's evaporated. Again, the Federal Reserve, by raising interest rates, lowering liquidity, and just sucking that easy money out of the system, is really hit and impact the crypto markets. Now, finally, I also discussed the real estate market. How is that happening, Rob? Well, think about this. Let's go to the board here. The 30-year fix earlier January. If you bought a home in January, you started the new year, you're sitting pretty because the 30-year fix was about 3.3%. Now, today, if you get in a mortgage, or you're in the fives, or well over 5, close to 6, and so that's a huge impact, slowing the brakes, pumping the brakes, slowing the economy is what the Fed is doing. So they went for stocks and bonds earlier this year. They went for the crypto market earlier this year, and now real estate as of right now. Now, the read was the existing home sales was down 5.9% for the month of July. But think about this. The last 6 months, it's a 6th month in a row of a negative print on that number. So declining month over month for the last 6 months, as well as year over year down 20%. Now, is the real estate market going to be the same condition as it was 2008, 2009? And the answer is no. Banks are better. The liquidity is there. The lending standards have been hopefully corrected, but they actually have been corrected. Unlike back then, if you could fog a mirror, you could get a mortgage, you could buy a house, and that frenzy kept going higher. Also, what's different this time, homes have, and home equity owners, if you think about it, last 2-3 years, we have equity in our homes. So real estate has appreciated tremendously. So there's another key quality factor. Now, the affordability has gone down, and so we're seeing home cancellations rise, and it's really affecting the lower to mid class Americans. And so the economy is going to be slowing down just as a natural reaction to what the Federal Reserve is doing. Now, this Friday, Jackson Hole, the Federal Reserve is going to be speaking to that. Basically, it's their annual conference, and Federal Reserve Chairman, we're going to be spending a lot of time watching what he's going to say and actually reacting. Markets will react to one way or another. Is he hawkish, meaning more tightening, bad cop, if you will, or dovish, saying, you know what, I know that all of my Fed counterparts earlier last week were very negative, but this week he's going to be very dovish or positive or accommodative. Now, whether the Fed pivots or pauses their interest rate hikes, we still believe that in September, they're going to price in a 75 basis points, at least that's what the markets expect, that's what we expect, another rate hike. Now, keep in mind that takes a long time to work its way into the economy, but not in the mortgage market. That hit pretty quickly, so we're going to see that knock-on effect. Now, within real estate, there's always an opportunity, but it really comes down to the supply and the demand and sort of the equilibrium that's playing out right now. Let's be honest, if you were selling, you want to what your neighbor got plus another 5 or 10% in this last, market cycle on the way up. Simply because your home, my home, is worth more than that, right? I just saw the highest sale in the neighborhood. I want that and then some, right? So that expectation has to be tempered, especially as more and more say, hey, wait a minute, they're going to add more supply. More people are going to be listing their homes. So with that additional additional inventory that we're seeing, the reduction in affordability because of interest rates are higher are going to equalize the supply and demand, which is actually a healthy thing long term, because sellers' expectations have to come down and buyers' expectations have to be met in the middle, and that's ultimately what makes a market, right? So is a recession? Not quite, but is it a managing expectations and a more of an equilibrium as the market works its way through? Yes. Now, what could go wrong? Well, it's always about the Federal Reserve. Do they continue to go and push mortgage rates higher and higher and higher? Maybe 6, maybe 7%. I don't know. It's a wait and see environment. That's the fear ultimately moving forward. How far does the Fed have to go before something breaks? We already saw bond and equity markets. We already saw cryptocurrency. We're feeling that in the real estate markets. So hopefully what we're going to be paying attention to is the job market, right? Corporations slowing down their hiring, maybe potential layoffs. We've already seen that if you read the Wall Street Journal every day like we do. More and more corporations are now basically laying off, especially in the big tech categories. And so that is going to help the job market supply and demand. And that's going to equalize. And so hopefully the Fed can engineer a soft landing. Finally, take a look at the Cheddar Link TV. Yesterday I was on the closing bell. And that's basically a recap of what we discussed today, but it's also a little bit more insight for you to watch. So that's our update for today. Thank you for watching. We'll see you again next time.